Welcome back to Real Estate Mindset. Today's video is gonna be absolutely bonkers. It's gonna be on the Fed starting quantitative tightening. Now, June 2022 is gonna be a month of turmoil for the financing market and for the housing market as the Federal Reserve is set to start quantitative tightening measures and the selling of mortgage-backed securities. So we are in for another bumpy ride starting right now. Now, remember, you guys, I am not your financial advisor. I know you guys play around with that. I'm just a YouTuber sharing my opinion. My bio is as a realtor, loan officer, and instructor in Texas. Email me at the email below if you have any more questions on that. But we're going to jump into an article from Market Watch titled Fed to Begin Quantitative Tightening, What That Means for Financial Markets. It's happening really quickly, guys, isn't it? Now, I know most of you want to see a negative equity drop or crash or correction or cool down, whatever the definition is. I know you guys want to see a 40 to 60% drop in home value. I'm happy with 15 to 20. Just so you guys know, I will be happy. I will consider myself a winner with just 15 to 20% drop in equity. I'm going to be so happy about that. But anyways, you guys, let's jump into this article right now. The Federal Reserve's almost $9 trillion asset portfolio is set to be reduced starting Wednesday in a process intended to supplement rate hikes and buttress the central bank's fight against inflation. While the precise impact of quantitative tightening in financial markets is still up for debate, analysts at Wells Fargo Investment Institute and capital economists agree that it's likely to produce another headwind for stocks. And that's a dilemma for investors facing multiple risks in their portfolios at the moment, as government bonds sold off and stocks nursed losses on Tuesday. In a nutshell, quantitative tightening is the opposite of quantitative easing. It's basically a way to reduce the money supply floating around the economy, and some say helps to augment rate hikes in a predictable manner. I don't know if anything's been predictable right until now, but how much remains unclear. And it may turn out to be anything but as dull as watching paint dry, as Janet Yellen described it when she was Fed chair in 2017, the last time when the central bank initiated a similar process. $9 trillion asset portfolio. Isn't that astonishing? Isn't the Federal Reserve pretty powerful? Can you see that they have many ways to manipulate the economy? Unfortunately, I think in this specific situation, I think they're too little, too late with taking these measures. Obviously, I think these should have been taken in 2021, but it's really astonishing to see that they have $9 trillion, right? Now, I believe once they start selling the $9 trillion, once they start unloading the balance sheet, I think the impact is going to be swift and is going to be severe in not only the stock market, but also the housing market. So we're going to start seeing that as the weeks start coming. And I'll probably update you guys again every Thursday. I have a housing market update video. We're going to start seeing those rate hikes again start in June on a residential mortgage side. Let's continue with this article right now. Quantitative tightening's main impact in the financial markets. It's seen as likely to drive up real or inflation-adjusted yields, which in turn makes stocks somewhat less attractive. And it should put upward pressure on Treasury term premia, or the compensation investors need for bearing interest rate risk over the life of the bond. So this is probably why we're going to have increasing mortgage residential rates, you guys. What's more, quantitative tightening comes at a time when investors are already in a pretty foul mood. Optimism about the short-term direction of the stock market is below 20% for the fourth time in 7 weeks, according to the results of a sentiment survey released Thursday by the American Association of Individual Investors. Meanwhile, President Joe Biden met with Fed Chairman Jerome Powell Tuesday afternoon to address inflation, the topic at the forefront of many investors' minds. Before we get back to the article, do me a favor, comment below and let me know if you think that the meeting that President Biden had with Fed Chair Jerome Powell, do y'all think that was helpful, or do you think it was a complete waste of time and completely political? Comment below. Do you think President Biden meeting Jerome Powell, do you think that's going to be helpful to us? Comment below. Let me know what you think. Let's go back to the article. I don't think we know the impacts of quantitative tightening just yet, especially since we haven't done this slimming down on the balance sheet much in history. The chief investment officer of Pittsburgh-based Fort Pitt Capital Group. But it's a safe bet to say that it pulls liquidity out of the market, and it's reasonable to think that as liquidity is pulled out, it affects multiples in valuation to some degree. Starting on Wednesday, the Fed will begin reducing its holding of Treasury securities, agency debt, and agency mortgage-backed securities by a combined $47.5 billion per month for the first 3 months. That's important. After this, the total amount to be reduced goes up to $95 billion a month, with policymakers prepared to adjust their approach as the economy and financial markets evolve. The reduction will occur as maturing securities roll off the Fed's portfolio and process are no longer reinvested. As of September, the roll-offs will be occurring at a substantially faster and more aggressive pace than the process which started in 2017, according to Wells Fargo Investment Institution. Okay, so for June, July, and August, the Federal Reserve is going to unload $47.5 billion in assets. And then after that, each month, they're going to double that essentially to $95 billion. And that, I believe, starts in September. So not only are we going to have the headwinds June, July, and August, and that's going to start, but it's also going to be a rapid acceleration starting in September of this year. So we're probably going to start seeing interest rates in the mid sixes, possibly high sixes, starting in September, or at least another surge starting in September. So what my guess is, June, another surge in residential mortgage interest rates, and then in September, another surge in residential mortgage rates, possibly hitting 7%. It sounds crazy to me that we would be in a market right now with 7% interest rates, being that house prices are so overvalued. But again, you guys, I don't think there's a soft landing possible. I think we're going to have a housing market crash, and the Federal Reserve taking these types of measures is only going to make that more and more realistic. Plus, not to mention, we're probably in a recession. But either way, let's get started and finish out this article right now. Andrew Hunter, a senior U.S. economist at Capital Economics, said that we expect the Fed to reduce its asset holdings by more than $3 trillion over the next couple of years, enough to bring the balance sheet back in line with the pre-pandemic level as a share of GDP. Though that shouldn't have a major impact on the economy. The Fed might stop quantitative tightening premature if economic conditions sour, he said. The main impact will come indirectly via the effects of financial conditions, with quantitative tightening putting upward pressure on Treasury term premiums, which alongside a further slowdown in economic growth will add to the headwinds facing the stock market. The key uncertainty is how long the Fed's rundown will last. So you guys, for me, it's really hard to imagine a Q2 of 2022. So Q2 right now, it's really hard for me to imagine positive GDP, because again, the Federal Reserve stopped purchasing, they're fixing to sell. I really don't think there's going to be a positive GDP in 2022, right? I think we're in recession right now. Go ahead and comment below. Let me know again if you guys think we're in recession, or possibly if we're not in recession. But if you don't think we're in recession, let me know why you don't think that. Now, I'm going to conclude this video, you guys, with just some overall conclusions that I've made after finishing reading this article. So overall, you guys, I'm really kind of excited because I'm preparing for this to watch this happen right before our eyes. We're literally going to watch the housing market crash right before our eyes. And unfortunately, I don't think a lot of people learned from the last mistakes that were made in 08 and 09, but I could be wrong. But either way, you guys, we are in a really good position. If you're like me and you're sitting back, you're being patient, you're having self-control, and you're waiting to purchase again, these are all signs that I am seeing that are going in our favor. Remember a few months ago when people said the government will never let this happen, we're not in recession, home values are going up? Look at how quickly that's changed. We're going to see a sudden surge of fear of missing out on the seller side. The buyer's market's coming back. But my question to you guys is, how long will this recession, correction, or crash last? I believe it's going to last 2 to 3 years. So I believe we're going to be good. There's going to be good buying opportunities for the next 2 to 3 years, starting Q4 of 2022. But comment below. Let me know what you guys think, how long this is going to last. And I always appreciate your guys' insight. We have some super smart subscribers on Real Estate Mindset, and I love you guys for that. Please keep commenting. Now, other than that, you guys, thank you for watching this video. And if you're out there investing in real estate, I do wish you luck, and I hope you win.